Hi there. Welcome to The Close. I'm Lindsay Biscaya in for Morella. Today, markets are closing in about half an hour from now. So first, let's get to some of the other stories we're following for you in the BNN Bloomberg newsroom. Statistics Canada says the country's merchandise trade deficit narrowed in December as growth in exports outpaced a rise in imports. The agency also notes that Canada recorded the widest annual shortfall on record for 2025, excluding the pandemic. Exports to other countries rose more than 17%, while shipments to the U.S. saw a decline. America's goods exports to Canada is now at its lowest since January of 2022. And shares of Canadian Tire are getting a boost after the retailer beat profit and revenue expectations in its most recent quarter. Revenue rose more than 8%, while same-store sales saw an increase compared to the year before. The results were driven by strong holiday demand and increased store traffic across its major banners. Shares of Molson Coors are down after the company posted lower than expected profit and sales in the fourth quarter. Molson says the sector continues to face significant headwinds as consumers tighten spending and younger generations show less interest in drinking. On top of that, increased aluminum prices have also taken a toll. Shares of Teck Resources are seeing some pressure today. The Canadian company posted revenue in its latest quarter that fell short of estimates and issued a capex outlook that was higher than expected. Teck's zinc production also came in below consensus. On the upside, profit beat estimates driven by a surge in copper prices. And we'll take a look at the TSX, up by 0.5% today. It's gaining after reaching a record high yesterday. Of course, material stocks doing well today for the most part. If we take a look at the U.S. markets, they're all trading down at the moment. The S&P 500 down by 0.4%, the Dow Jones down by 0.6%, and the NASDAQ composite down by 0.5% as well. So a bit of a sell-off there. So let's get more on that with Carol Schlief, Chief Market Strategist at BMO Private Wealth, and she joins us now. It's good to have you. Thanks so much for joining us.
Hey, thanks for having me.
So what do you make of what we're seeing today, particularly in the U.S. markets? It looks like a bit of a sell-off.
Yeah, I think a piece of what we've got going on in the U.S. is we're trying to make that transition, if you will, from the Magnificent Seven leading the parade to a much broader participation. And it's been a bit rocky as that transition happens. And there's also been a lot of volatility in some of the new AI announcements, and investors are trying to figure out how they deal with it. But taking a step back from the intraday or the short-term trading, if you will, we continue to believe that things are teed up. You look at the results coming out of the earnings season, and things are teed up for some pretty strong growth this year. And we suspect, given the adoption of new technologies, that you'll see faster growth with lower inflation than many expect.
Okay,
so far.
So it sounds as though you don't think that this kind of indicates expectations of economic softness, maybe the opposite.
No, we definitely think you've got some transition going on, and markets are trying to absorb that. And actually, when you look at it year to date, you've seen the NASDAQ and the Mag 7 flat to down a little bit, and you've got small and mid cap and other industries up close to double digits. So you're seeing that widening happen. And the AI, we're still spending on data centers. We're still deploying that use cases in a lot of different situations. And there's a lot of technology rollout that continues. And the earnings season that we're wrapping up here in the U.S. with the retailers still to come, but for the most part, 80 or 90% of companies are in, and the bottom line's growing double digits, top line's growing strong single digits, and companies are showing lots of margin enhancement, if you will, and it's broad spread. It's not just AI leading the parade.
Interesting. If we take a look at U.S. trade data, which showed that the deficit remained largely unchanged from a year ago, that data coming out this week, I wonder what that suggests to you. Like, does that show that consumers were kind of front loading when it comes to getting like ahead of tariffs, ahead of imports, or does it show that the tariffs are basically ineffective?
Well, the deficit's down a bit. The tariffs were nowhere near the sort of across the board hit that many feared. There's definitely tariff impact in select spots, but there's also a very strong consumer. Employment stayed very strong through the year. You've got a lot of policy changes that companies and consumers in general are still trying to sort through. So we almost think it's a little too early to put a period or a fine line on all of that. There's still a lot of things that are sorting their way through the system, and it'll take another couple of quarters to see that. But the underlying strength is that the demand is still there. We've seen a lot of green shoots in the last week or two, particularly in manufacturing data. And manufacturing, as you know, has kind of stayed by the side on the sidelines for the most part, trying to see how these policies sort themselves out, because you've got immigration, you've got trade, you've got the tariff issues, and those aren't settled yet either. There's rumblings that some steel and aluminum relief might be in the wings as well.
Yeah, because Donald Trump seems confident that the United States can reduce that trade deficit. You mentioned the green shoots you're seeing in the manufacturing sector. Do you think it's likely that gap can be closed?
Hey, we'll see if the gap can be closed. But I mean, last year we were at a point where we were running more like 7%. We're still waiting on the Supreme Court to decide whether or not those countrywide tariffs are legal. There are other industries as well that they're on. So tariffs are here to stay. They're higher than they were last January, lower than they were threatened in April. And so, tariffs are clearly a policy that's here to stay on that front. But we think businesses are slowly but surely getting more clarity on things. We think growth helps some things, but there are fiscal stimulus parts to the One Big Beautiful Bill that also will impact that. So getting it closed is not on anybody's radar, but hopefully getting it stabilized and narrowed some, because we have seen a big pullback in government expenditures, not the least of which is through several 100,000 government workers being sent into the private sector, if you will, through early retirements and DOGE actions and other things.
Mm-hmm. Yeah, a lot of movement. I want to switch gears and talk about gold for a little bit. Obviously, gold saw strong performance in 2025, a little more volatile this year, but we've seen investors using it as that kind of like safe haven. What should investors be avoiding on the flip side of that? Or do you think that they should be using it as a safe haven?
I think the thing with precious metals is they're tough to value like they are. I spend most of my time looking at stocks and bonds, which are easier to value, if you will, on core fundamentals and various things, discounted cash flows and other things like that. Gold, cryptocurrencies are tougher to value because it all depends on where the demand issues are different. We've had lots of central bank buying in the last couple of years as haven assets. So really, if an investor wants to own gold, they have to understand why they want to own it and what risks they're trying to hedge. Precious metals in general is that way. And so then they've got to figure out what level they're comfortable paying and tuck it away. As for many investors, gold ends up being that this allows me to sleep at night, because if everything else in the world really blows up, I still know I've got real assets in some form of gold. And in many cases, if you're buying gold bars, you can touch it and feel it. And so it's a different purchase decision than buying stocks or buying bonds is.
Yeah, a good point. Okay, we will have to leave it there. That's all the time we have. Kara Schlief, Chief Market Strategist at BMO Private Wealth. Appreciate your time and your insight. Thank you.
Thank you. Thanks.
Meanwhile, Canada's trade deficit just hit new highs. We will break down the numbers when we come back. Stay with us. Canada's trade deficit widened to $31.3 billion last year. That is the biggest annual gap we've seen outside of the pandemic, as U.S. tariffs took a major toll on key Canadian exports. So for more on what's driving these numbers and what comes next, we are joined now by Bloomberg's Nejud Al-Malisi. It's good to have you join us. Thanks so much. So
Thanks for having me.
Let's talk first of all about the overall impact of U.S. tariffs on Canada's trade balance last year. Like, just how much of an impact did it have?
Well, as you highlighted just earlier, this is the largest trade deficit on record for Canada outside of 2020, and that was during the COVID-19 pandemic when we saw business activity and cross-border trade stall because of public health measures. So it is a significant impact that we see here in the trade data, and it really shows the extent to which Canada's trading relationship with the United States has been upended. You see how businesses have been trying to send their goods elsewhere in the world. The exports to the U.S. tumbled 5.8% in 2025, and as we know, most goods from Canada do go to the United States, but that proportion of exports that go to the U.S. fell last year from 76% to 72%, while we saw exports to other countries rise. And so it was a tumultuous year for businesses, and that's quite clear in the trade data today.
It's so interesting. The run-up in gold prices might have helped at least mask the impacts of the trade war. Can you explain how gold exports might have done that?
For sure. So every month, looking at the data, it was quite volatile because of these big swings in gold exports, and the rise in price of gold has fudged around the numbers a little bit, masking how challenging the trade war and U.S. tariffs have been for Canadian businesses. And so we know last year exports of gold were up nearly 42%. And so if you actually take gold out of the picture, Canadian exports are down 3% in 2025 instead of 0.2%, which is the overall number that you look at. And so that has been a wild card in the picture, and you kind of have to pull that back a little bit to get a real sense of the damage of U.S. tariffs on the Canadian economy.
Interesting. What about when we look at the year ahead? Of course, everyone's watching for that upcoming CUSMA renegotiation, but what's the outlook for trade for this year?
Well, if you look back at 2025, there was a lot of uncertainty about which tariffs would be in place and for how long and on what sectors. And there were a lot of different changes that happened month to month, starting with broad tariffs that were then narrowed to goods that are not compliant with the USMCA, and then sectoral tariffs. And so the results of this review this summer of the USMCA will be quite significant and pivotal in terms of determining, does this volatility in our trading relationship, the decline in U.S. exports, is that something permanent? Is it going to worsen, or is it going to get better? And so a lot more uncertainty this year, and the talks this summer between the Carney government and Trump administration will let us know how Canada's trading relationship with the U.S. and the rest of the world is set to change temporarily or permanently.
Okay, lots to watch for. That was Bloomberg reporter Najoud Al-Malisi joining us. Thanks so much for your time. Appreciate it. Up next, shares of Deere & Co. soared today after the world's largest farm equipment maker raised its annual report forecast and beat first quarter results estimates. More on that coming up in a moment. The Canadian Real Estate Association says that the harsh winter weather may be hitting hard for the decline of house sales. And for more on the outlook, CTV's Heather Wright filed this report.
That January snowstorm that buried parts of southern Ontario in as much as 60 centimeters of snow and left many roads impassable for days is now being blamed for more than just messy driving.
The first day we had one party.
Alan Nasseri is a real estate broker and says a typical open house usually has about 10 interested parties. But last month, some were virtually empty. He says the weather played a role in the slow month, but so too did economic uncertainty.
There are way less buyers in the market as that confidence in the market, at least based on our observation, is not there at this time.
Winter storms compounded an already cooling real estate sector as home sales across Canada fell to multi-year lows last month, according to the Canadian Real Estate Association.
The national numbers were definitely impacted in January by that big storm that came up through southwestern Ontario and the entire GTA.
Home sales were down more than 16% in January compared to the year before and down nearly 6% compared to December sales. Despite lower interest rates and falling home prices, houses are still expensive in many markets. And while new listings rose, there is a lack of inventory when it comes to what many buyers actually want.
Housing stock and what's available in the market is a lot of very expensive detached homes and a lot of small condos, and not a lot of sort of family-friendly, affordable middle stuff.
While Korea expects the market will pick up at some point this year, economists say the extent of any rebound won't be clear until at least the spring. Heather Wright, CTV News, Toronto.
Shares of Deere & Co. are up 11% today after the company raised its fiscal year outlook and said demand in the construction and small agricultural markets was recovering. Despite the beat, our next guest still maintains a short rating on the stock. So let's welcome in Jay Van Sciver, partner and industrial sector head at Hedgeye Risk Management. It's good to have you join us. Thank you for your time.
Thank you so much for having me.
So I'm wondering why the short rating after what we're seeing today. Is there some areas of weakness that you think are being overlooked?
Well, first, this is a seasonally not that important quarter. So a lot of what they've seen so far in 2026 isn't all that representative of what the year will be like. And you started to hear them point to biofuels. And what you've seen over, say, the last 5 years is a topping out in ethanol demand. Corn-based ethanol is the most important market for ag and therefore for Deere's capital equipment. And that is something that is going to, I think, enter secular decline as electric vehicles take share in the fleet.
Interesting. Okay, so the company referenced cost-cutting initiatives to protect margins. Did they specify any particular measures at all?
Well, I think they mostly pointed to the macro environment, this idea that the USDA is expecting revenues to be up, farm revenues to be up, farm income 3%, and a lot of that is related to government transfer payment and government support in the U.S. I think what you're looking at primarily is a company that reported a pretty good revenue quarter, actually, and down EPS, down almost 25%. So when you have revenue up and sales down because you're cutting price and margins are narrowing in your best segment, it's a difficult story. So typically in that environment, they're going to turn to cost cutting.
So I do take your point on why maybe investors should be looking at this a little cautiously, but Deere has raised its fiscal year outlook, citing recovering demand in construction and small agricultural markets. What factors do you think are maybe contributing to this turnaround?
I think the reason they gave that guidance is that they're hosting Analyst Day in about 2 weeks. And the last thing a public company wants to do when heading into an Analyst Day is, cut guidance or give weak guidance into what's a crowd that will basically contain all of their fans and all of their critics. So when you have that kind of near-term, event for a management team, there's a real incentive to give a rosier outlook for 2026 than maybe you would have in the absence of it.
Okay, so you're a little bit skeptical about that guidance then, is what you're saying.
Sure. No, I mean, ConExpo is a very important event across the sort of manufacturing and construction equipment industry. And Deere hosts its Analyst Day at that event. That's a big Analyst Day for them. And I think you've heard this company for the last several years tell you that ag is bottoming, and ag continues then not to bottom.
Mm-hmm. Tariffs imposed by President Donald Trump have also kind of affected profits in the past for John Deere. Do you expect that will be any different for the year ahead?
Well, I think you have a lot of potential interesting factors on tariffs, like the Supreme Court's IEEPA decision may come out tomorrow, an important catalyst where they will decide whether or not the implementation of Trump's use of that is appropriate given the law. And then there's also a factor around Chinese purchases and whether they actually follow through. We've seen a lot of purchase commitments over time that haven't quite borne out in the way investors expected.
It's interesting, too, when you look at the company's growth, which slowed since 2024 before tariffs were actually implemented. So where do you think that kind of drop off was coming from before?
I think what you've seen is the topping off of ethanol demand, right? That's when you start to see electric vehicle sales pick up. Then you have an effect in terms of just total land value, leverage access. It affects the amount of equipment that's actually on acreage. I mean, the real effect of all of that is it takes down used equipment values. So when you go to trade in your combine or your tractor, you end up with the negative equity associated with your loan on the new purchase payment and higher interest rates. These are all sort of compound. These are all very big positives on the way up and have been significant negatives on the way down.
So you've talked at the top there just now about more electric vehicles coming on the market, maybe affecting John Deere's growth. Is there a way you think the company should be kind of pivoting and adapting to some of these changes?
Yes, you're seeing them do it. They're getting out of farm equipment and into excavators. They're trying to make more construction equipment. They're buying companies like Wirtgen. I guess they bought it a little bit ago, but not that long ago, getting to diversify away from their sort of core market of large ag, these sort of cash crop markets, ethanol, or corn, soy, and wheat are their big markets, and their two big, geographic markets are the U.S. and Brazil.
Just lastly, before I let you go, there's a lot of AI-powered farm equipment coming onto the market, like autonomous tractors, precision agricultural platforms. I think you touched on this, but how is the company maybe working to accelerate that?
I mean, they've been investing in sort of machine vision, autonomy, things along those lines for a long time. And Deere deserves some credit for being forward-thinking in their embrace of sort of technology. Retrofit kits are an interesting way to deal with weak used prices that they've adopted, where you can get some of these technologies on existing tractors, in a sense, kind of hurting their future sales, but to maintain a relationship with the customer. I think anytime you have a significant disruption in a market like this, where you have a new technology emerge, there's risks for the established player like Deere, and I think they're doing their best to stay ahead of that. And farmers are not the earliest adopters of technology, but it is, I think, a potential source of competitive, pressure. You could see a new entrant come in with a new autonomous solution that's more advanced than Deere has. I haven't seen that yet, but that's a risk for them.
Okay, very interesting. We will leave it there. Jay Van Sciver, partner and industrial sector head at Hedgeye Risk Management. Appreciate your time today. Thanks for joining us.
Thank you so much.
And we'll take one last look at the markets before they close for today. We will watch the TSX today, potentially going for another record high after what we saw yesterday, above 33,000. I think it was 33,800 and something yesterday. So we'll continue to watch that. It's just below the record that it set. And then if we take a look at U.S. markets, as we mentioned, there's a bit of a sell-off happening today. So trading down, S&P 500 down by 0.3% at the moment. The Dow Jones is down by 0.6%, and the NASDAQ composite down by 0.4%. Investors a little wary, and also the ongoing talks between the U.S. and Iran seem to be weighing on these markets as well. Up next, we've got the closing bells on Bay Street and Wall Street. We'll be right back. Stay with us. Here are the closing bells at the NASDAQ. Apogee Therapeutics is ringing the closing bell. The New York Stock Exchange, Aris Mining Corporation, to celebrate its uplisting from the New York Stock Exchange American to the NYSE, and the debut of its new ticker symbol, which is ARIS. And the TSX, Canadian Security Traders Association's Winter Vendor Fair 2026 is closing the market. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Streets. The TSX hit another record high today after we saw a record high yesterday. So TSX closing up by 0.6% to finish the day. And material stocks doing really well today, pushing the TSX up higher. Not so much for the S&P 500 and the NASDAQ composite, and in the day trading down. If we look at some of the big market movers, First Majestic was a big one today on the TSX. It was one of the best performers on the TSX after the mining company reported fourth quarter results that beat estimates, finishing the day above 9%. More on that in a moment, of course, when it comes to First Majestic Silver. We'll be talking about that. Torex Gold was another one of the top performers today on the TSX after beating estimates in its fourth quarter too, finishing up, trading up more than almost 11% to end the day. If we take a look at some other stocks, Brookfield Asset Management was trading down today, one of the biggest laggers on the TSX, finishing the day down almost 5%. Elsewhere, though, we're watching some other stocks. Tesla had an interesting story today. Shares were dropping earlier, ended the day relatively flat, but this comes after New York Governor Kathy Hochul pulled a proposal to launch robo-taxis outside of New York City. That is affecting the Tesla stock a little bit today. And another story we've been following closely for you is Molson Coors, ending the day down by more than 3%. The stock dropping after the latest earnings shows a drop in profit and sales. It appears younger generations just not drinking enough. Okay, so for more on some of these bigger movers, we're joined now by Bloomberg's equities reporter Stephanie Hughes to break some of them down. So Stephanie, we will start with Canadian Tire. What's going on with this company today?
Hey, Lindsay. Yeah, so Canadian Tire was a bit of a weird stock trader today, and let me explain why. So first, shares came roaring out of the market open, soaring by nearly 7% at its highest point, which brought the stock price to its highest level since August 2021. And it was also on track to almost hit a new all-time high. But then it ended up reversing just all of the gains there today, going deeper into the red. And the reason isn't immediately clear. Maybe as the trading day went on, traders were weighing the quality of the results, or maybe they were looking at some of the commentary from the conference call, flagging some of the risks. But the results themselves, the retailer posted a pretty big beat compared to what analysts were expecting. They reported normalized earnings of $4.47 per share. That came well ahead of the $3.83 analysts were expecting. Revenue was also a beat. So a few things drove the results. One of them was a particularly strong holiday season, and it probably didn't hurt that we had some winter weather that had people like yours truly here buying a new shovel and some ice salt. There was a lot of people flocking to retailers like Canadian Tire. And in fact, CEO Greg Hicks said that it was one of the strongest or best holiday seasons on record. And he also said that there was a lot of surprising strength in the Canadian consumer resilience, just based during a year where that was really characterized by economic uncertainty coming from trade relations. So the analyst community was pretty happy with what they saw. We had TD Cowen's Brian Morrison saying that the earnings beat was evenly distributed among the retail segment and then the financial services segment. Recall that it has a retail credit card offering, and then also benefited from a lower tax rate. Then you had Scotiabank's John Zamparo saying that there was a lot of sales in Sport Chek and Marks. So there was a lot going for Canadian Tire today, which initially had that rise up, but then kind of fizzled out as the trading day went on, Lindsay.
Mm-hmm. Another one we're watching, we're just talking about, is First Majestic Silver. I was just looking at, ended the day as the second best performer on the TSX after some strong results. So what are we watching for there?
Yeah, that's right. It was actually it was on the top for a bit there and really battling it out for the top spot on the TSX until, unfortunately, for First Majestic, they were overtaken. But still, pretty good showing for the precious metals miner, mostly focusing on silver. That stock jumped by 10% at its highest point, biggest surge in just over a month. And that helped the company, that was because the company reported adjusted earnings and revenue that came ahead of what analysts were expecting. And total silver production was a bit of a beat as well. TD Cowen's Wayne Lamb said that this was a strong close to the year and pointed to robust free cash flow for the company that should really bolster the balance sheet. They also added that a lot of this free cash flow capital could go towards certain growth initiatives for the companies. So maybe there's some optimism among traders and analysts that First Majestic can really build on that momentum using those investments and piling it further into the projects. And maybe we'll see that play out over the next few quarters, Lindsay.
Mm-hmm. Be interesting to watch for that. Okay, that is Bloomberg's Stephanie Hughes joining us live as always. Thanks so much, Stephanie. Up next, the TSX closed slightly higher today while major U.S. indices declined amid heightened economic and geopolitical uncertainty. We've got more on that coming up in a moment. Welcome back to The Close. For more on the markets now, we're going to bring in Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Wealth. Good to have you join us. Love the jersey. Thanks so much.
Great to be here. Winning day for the TSX. I'm sure we all would have traded it for the gold medal for our women's hockey team. Proud of them still. They put up a good fight.
Yeah, I know. Silver is not what they wanted to see, but still silver is pretty good. Okay, so let's talk a little bit more about the markets instead. We're observing higher commodity prices right now. Like gold prices are up, oil prices are up, driven a lot by geopolitical concerns. I know you've stressed in the past that when you're investing, you shouldn't really be focusing on politics. But at this point, do you believe uncertainty within the geopolitical world is still going to, push prices higher when it comes to commodities?
Gold, not being up more today is actually a bit telling, I would say, given the nervousness that we're seeing in oil prices. The oil obviously is region specific given Iran. When we think about politics and geopolitics and our investment portfolios, I'm really trying to talk about separating our raw emotions, and very much for Canada in the last 12, 14, 18 months with the trade frictions, and focus on what is it about a particular event that might impact the fundamentals that we really do have to sort of, just keep focused on. And that's earnings, borrowing costs, inflation, wages, commodity prices, things of that nature. So it's not paying attention to it in terms of your portfolio, but it's your emotional response. Try to be very clinical and disciplined. As it relates to today's developments and oil prices, we're up $10 or more from what is pretty low oil prices at the end of December. That's baking in, I think, some of this uncertainty in the Middle East. We're not looking at fundamental supply-demand issues. The world's awash in oil. So it's a question of accessibility. If there was something that would close the Strait of Hormuz, then certainly we would have an issue. It's early days in terms of where this is headed, and the world can still function at $75, $80 oil. Obviously, it was a boost for the TSX on the energy sector today. And so we try to stay calm with that. It's not a non-issue, but keep it in perspective.
Okay. When it comes to companies and earnings season, we've seen a lot reporting a beat on earnings, yet their stocks have still been penalized, it appears, for a lot of companies. Why do you think investors have this kind of cautious outlook on so many companies that are actually reporting a beat on earnings?
Today's a great example with both sides of the board. You had Walmart and Canadian Tire that you guys were talking about a moment ago. It is odd, right? They both posted good results. The Walmart conference call was a bit tepid on their outlook. Those bellwethers would certainly normally signal that the consumer has been in strong, with strength, and obviously earnings are always backward looking. The concern is about going forward, this lower end of the consumer, which both of those retailers, have a contingent of that. How are they going to be stretched? And it does feed back into the oil price conversation. If oil prices are going up, it may not necessarily move the needle a whole pile on the overall inflation picture, but consumer sentiment is very sensitive to oil prices. Inflation expectations are very sensitive to oil prices, outsized to what they really impact on actual inflation numbers. And so that can bring in some nervousness. I think that the weakness for employment is largely behind us. And productivity gains, everybody worrying about, AI going to put me out of a job, I think is far down the road. We generally would see productivity gains, CapEx investment, and then an uptick in employment. So I think some of the softness is behind us.
Okay, but when we're talking about that softness, some of the weakness on the S&P is in certain sectors like financials, technology, consumer discretionary. Is this a good time to get in and buy on some of those sectors that are a little weaker?
We're still constructive on the U.S. market. I'm very pleased to see that the rotation trade has been playing out really now for 6 months. Those sectors had been big beneficiaries over the last 3 to 6 months. Small caps and mid caps, you could throw into that category as well. So I think we're just taking a healthy pause after what was a pretty good run for some of those sectors. With the rest of the world up 5% in Canada on a year-to-date basis. Europe, Japan, places like South Korea up, very strong out of the gate here. The U.S. is starting to look a little more attractive on a relative basis. There's still high valuations, but it hasn't had the rip. And certainly when you go back 6 or 8 months, it has been treading water sideways. You can correct some of the exuberance in markets through price correction or time. And this has really been more of a time correction for the U.S. market. And so it makes me more constructive towards the rest of the year on the U.S. market.
I'm wondering how you're feeling about the software sector, because it's continuing to underperform after taking a hit a couple of weeks ago. Do you expect that weakness to continue?
This is, very fast unfolding story with how artificial intelligence might impact various businesses. I do think on certain companies, there's probably a lot's been overdone. I don't think you can think about large, heavily regulated sectors. The legal profession would be one, financial services would be another, that are going to use unvarnished, unfettered access to artificial intelligence. Some of these software as a service intermediaries that have been hit hard. I do think there is a case for artificial intelligence being adjacent to their businesses. Maybe that does have some impact on their margins and their earnings going forward. But it does look like there's been quite a shoot first, ask questions later in that space. And that's not unusual for how fast this is moving, and analysts and investors needing to do some research, do some reading, and get caught up on what it actually might mean.
Yeah, it's such quick reaction, right? When it comes to 2026, how are you positioning your fixed income portfolio for the year?
Yeah, fixed income, I think, we've described it as a nothing burger. There's a lot of hand-wringing over whether you're going to see one cut, one hike in different central banks, the U.S. and Canada. We've seen Australia pull the trigger a bit. I would say in general, the backdrop is easy financial conditions and not expecting major moves. Window dressing of a quarter point here, whether the Fed goes half or a quarter or three quarters of a percent. We can make some money at the margin in that. And so for what we're doing in fixed income is taking up the spread that we're getting in both investment grade and down the credit spectrum for the fixed income exposure. There's not a lot of meat on the bone. The spreads there are tight, but the all-in yields are still attractive. And because we don't expect a lot of fireworks in fixed income, then that's where we want to play that this year.
All right, we will have to leave it there. Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Wealth. Good to have you join us today. Thanks so much.
Great to be here. Have a great day.
You too. We're continuing to follow Newmont's fourth quarter results, which have just come out this afternoon. Adjusted EPS of $2.52, beating the estimate of $2.02. This, of course, driven by soaring metal prices. So sales for Newmont came in at $6.82 billion. The estimate was $6.3 billion. So a beat there. You can see Newmont reacting to this after hours, up by 0.6%, their stock price, that is, at the moment. Attributable gold production came in at 1.45 million ounces, and adjusted EBITDA came in at 4.5 billion, also beating the estimate of 3.9 billion. For the year, Newmont sees attributable gold production about 5.3 million ounces, which also is beating estimates. Meanwhile, shares of Cenovus are getting a lift today after the Calgary-based company posted better than expected adjusted profit and revenue. So we will break that down for you when we come back. Stay with us. Shares of Cenovus got a boost today after the Alberta-based company logged a beat on profit and revenue. So here to tell us more is Menno Hulshoff, Managing Director at Equity Research at TD Cowen. It's good to have you join us. Thanks for your time.
Thanks for having me on.
So let's go through these kind of better than expected results. What's behind this?
Yeah, it was a good quarter from Cenovus across the board, both upstream and downstream. On the upstream side of things, they posted record top line production. That was expected given the MEG acquisition. But I think the important piece here is that we saw production records set across all major upstream assets, including Foster Creek, Christina Lake, and Sunrise. And similarly, U.S. downstream, as you may appreciate, that's been a headwind for the stock, but the performance there was quite strong as well from a market capture and utilization perspective, despite weak crack spreads. So I would say that Cenovus delivered on everything that it could control in the quarter. And I think that makes for a solid downstream setup through the middle of the year, given limited turnaround activity and seasonal strength. And then when you think about the results on the cash flow per share side of things, not surprisingly, strong asset level performance drove a roughly 6% beat relative to our estimates after a couple of larger adjustments. But beyond the quarter, I think it's all about delivering on best-in-class production and free cash flow per share. growth in 2026 and beyond as production ramps and growth capital starts to fall. And the good news from the quarter and from the conference call, for that matter, was that all of their growth projects are tracking per guidance or slightly ahead of guidance, including Narrows Lake and the Foster Creek Optimization Project. Now, the one project that we are keeping an eye on is West White Rose, which is offshore East Coast. And Cenovus continues to guide Q2 for first oil, but did suggest on the conference call that that timeline might be a bit tight. So we are keeping an eye on that one. But even with a slight delay, we would argue that the window for material delays or overrun has effectively closed. So we like Cenovus here. I think it remains one of the most interesting names within our coverage from a rate of change perspective, along with Suncor. And when you think about shareholder capital returns, they continue to return 50% of free cash flow, and that's expected to increase to 75% when net debt falls to $6 billion. So we continue to like it here, notwithstanding the recent strength.
It's interesting how you say that Cenovus is doing well within all the areas that it can control, right? Because there's so many factors out of an oil and gas company in Canada's control right now, including, we're seeing lower crude prices, generally lower crude prices recently. How is Cenovus managing the lower cost per barrel?
Yeah, I think it's a combination of a lot of different things. They've made a big push to lower their break-even costs coming out of the 2020 COVID downturn, and now they have a break even down to $45 WTI, which is a very comfortable place relative to where we sit today. And the other piece that is worth highlighting, of course, is the integration of the business. They have a very significant U.S. downstream footprint, which helps mitigate volatility in oil prices, and the Canadian downstream side of the business continues to perform very well as well.
Obviously, a big story as well. I think you might have touched on this briefly, but Cenovus acquiring MEG Energy. How is that factoring into some of the results in Cenovus's production moving forward?
Yeah, it's early days, but the integration is going very well. They talked about that extensively on the conference call. There haven't been any hiccups in terms of the integration to date. And when you think about the synergies upside from that deal, they were guiding $150 million in synergies over the near term, increasing to about $400 million in synergies by 2028. And I think the interesting piece there is that they managed to generate $120 million of the $150 million near-term target within 6 weeks of closing of the transaction. So it continues to integrate extremely well. And I think there's probably, we don't know definitively, but if I had to guess, if we were having this conversation a year from now, that synergies estimate is potentially even a bit higher.
Given the demand for data centers that we're seeing and probably will continue to see into the future, is Cenovus expecting higher natural gas prices?
Yeah, I wouldn't. Like Cenovus, they do have a fairly significant footprint in a play called the Deep Basin, and that's where they generate most of their natural gas. But their natural gas sensitivity is very low, simply because they consume a lot of it within their core SAGD business. But they do have a bit of a gas weighting, but it's not going to be, in my mind, a tailwind for the stock, even if we do see a significant uptick in natural gas demand on the back of the proliferation of AI data centers.
A big conversation in January was whether Venezuelan oil would be threatening Canadian crude oil and Canadian oil and gas companies. That's kind of died down. Not as many people talking about that this month, but we know Mark Carney has said that he's not worried about that. Would you agree with that? And do you think that's something Cenovus is looking at in the future?
I would say that most of the companies in my coverage are, I mean, it's too early to say. The visibility is extremely low. We don't really know how things are going to play out, but we have seen the heavy differential come under pressure of late. As of yesterday's close, it was just under $16, and that's a bigger number than we would have expected even 3 months ago. Like, to be fair, it is a seasonally weak time of year, but even if we look at things on a year-on-year basis, the heavy differential is about $2 a barrel wider than this time last year. In terms of why, and I'll get to the Venezuela piece, but I think the biggest reason is probably Western Canadian supply, which hit record highs in December and does appear to be impacting Enbridge mainline apportionment, which rose to about 22% for heavy oil in February. But when you think about Venezuelan imports into the U.S. Gulf Coast and the potential to have those backing out Western Canadian heavies, we haven't actually seen that yet. We've seen imports rise into the 150, 155,000 barrel per day range, but that's only up marginally from early January when the U.S. triggered regime change. But it is something that the industry is taking very seriously, and it can go a lot of different ways.
Okay, we're going to have to leave it there. We're out of time. Menno Hulshoff, appreciate you joining us today. Thank you.
Thank you.
And Menno is the managing director of equity research at TD Cowen. Up next, we're taking a look at Walmart's latest earnings as the retail giant has been dethroned by Amazon. That is after the break. Walmart has reported their fourth quarter earnings, which beat estimates, but the retail giant was dethroned today by Amazon as the largest global company by revenue. We've got Michael Baker, managing director and senior research analyst at D.A. Davidson, joining us now to break all of this down. It's good to have you. Thanks for joining us.
Hi, glad to be here. Thanks.
This is a pretty interesting development. Do you see Walmart reclaiming this throne at all?
Well, remember, Amazon has a lot of different businesses, their AWS business, so it's not exactly apples to apples. To me, it's good enough to think of both of these retailers, along with Costco in the U.S., taking market share from everybody else. Whether one's a little bit bigger than the other really doesn't matter. I think they're both very well positioned in taking market share from less well-capitalized retailers.
We know Walmart, though, has gone through 5 CEOs recently, with John Furner taking over on February 1st. He's been with the company for decades. Do you expect strong results under his leadership?
I don't expect much to change at all. He's been with the company for a long time, arguably Doug McMillan's right-hand man, so we don't expect a lot to change. Business as usual. His 5th CEO, that's actually not that many when you consider, going back to Sam Walton, and then just, a couple more since then. It's really been very consistent, and we expect that to continue.
We've seen a lot of grocers moving into this new world of AI, right? Like partnering with different AI. Loblaws, for example, partnered with ChatGPT. Walmart has its own called Sparky. That's its own AI assistant. What do you think about Sparky, and does that have meaningful progress moving forward for Walmart in 2026?
Yeah, some of the numbers that Walmart talked about with Sparky on today's call were pretty impressive. 50% of Walmart's online users are engaging with Sparky in some way. Those customers that do engage with Sparky have a 35% higher average basket because Sparky, which is their agentic commerce solution, does help with discovery. By the way, along with that internal solution for agentic commerce, Walmart is partnering with both OpenAI, ChatGPT, as well as Google Gemini products. So really, we think of Amazon and Walmart as the winners within the agentic commerce competition.
Interesting. So when it comes to Walmart and where they are now, do you think they're stuck in kind of like a steady state now?
Well, no, I think they're growing, and I think they will continue to grow. We see them as really well positioned. They are achieving their growth algorithm, if you will, which is at least 4% sales growth and operating profit growth higher than that, 4 to 8% growth. So we think at least mid-single digit earnings growth, if not higher. Some of their alternative businesses, which are really the margin drivers, think about media, et cetera, are really in the very early stages. To put some numbers to that, their advertising business is about $6 or $7 billion in sales right now. Amazon is closer to $70 billion. So really in the very early innings of that kind of business, and we think they have a long way to go.
What are some of the biggest risks, do you think, facing the company?
Right now, of anything, we think it's valuation. I mean, they're really producing very well. Sales growth, profit growth, everything clicking really well for Walmart. The biggest risk is it's trading at 45 times earnings. We saw a different retailer yesterday, Carvana, trading at a very high multiple, have a little bit of a wobble in terms of some of their expenses, and the stock got killed. So To me, that's the biggest issue with Walmart's stock is just that kind of little bit of a misstep that we don't foresee coming within a high valuation. Their guidance today for 2026 was a little bit below consensus. That had a little bit of pressure on the stock, but I think investors rightfully see that as beatable and conservative. So not that big of a worry at all.
Okay, we will leave it there. Michael Baker, Managing Director and Senior Research Analyst at D.A. Davidson. Appreciate your time and your insight. Thank you.
Sure. Great to talk to you.
Coming up, we will bring you our conversation with the CEO of MDA Space about the future of Canadian defense. That's coming up right after the break. MDA Space formally expanded its operations with the creation of 49 North. The subsidiary will focus on Canada's national defense priorities outside of the space domain. And for more on the future of Canadian defense, we spoke with Mike Greenlee, CEO of MDA Space.
50 years of history in the defense sector, both in space, of course, but also in non-space, in Army, Navy, Air Force, and joint communications activity. And so we wanted to be able to take the non-space aspect, put it in 49 North, create a wholly owned subsidiary with its own president in Joe Armstrong, and be able to focus that in the market to be able to build Canadian systems and to be able to partner with international partners to bring solutions to the Canadian defense market.
And what will you be focusing on with defense? What will be your target?
Our history in defense in the non-space area includes autonomous systems. We've been one of the premier providers of unmanned aerial vehicles to the Canadian Army and Air Force over the last year since Afghanistan, in command, control, communication systems, in intelligence, surveillance, and reconnaissance systems, sensors, and in-service support to those systems once deployed.
And there are some, I guess, I imagine for you, there must be some tremendous opportunities with the expansion of spending on defense. How do you see this growing, and what opportunities do you see? Is it going to be focusing on those unmanned, or will there be one area of the ones you just mentioned that will get more focus than the others?
Yeah, certainly unmanned will get a fair amount of attention. We're busy these days delivering the remotely piloted air system, the RPAS system for the Canadian Air Force, and the Royal Canadian Navy's unmanned vehicle program, which we recently won and are delivering on. We'll look for more opportunities in that area, which will certainly be a focus of all defense expansion around the world as the various defense forces continue to expand. So we'll be looking to leverage that position in Canada to do more. But also in sensors, we're building sensors for the next generation river-class destroyers, the next generation surface ships for the Canadian Navy, and command, control, and communications as we bring secure communications and sensor integration to various systems. With Canada's focus on increased sovereignty and security, it'll be very important to be able to look at all of our sensor environment and how those sensors come to create a picture of Canadian security or military security internationally, and then to be able to provide the necessary secure communications for military operations, both across Canada and in the North, and internationally when deployed.
And I imagine the unmanned and the sensors, and that must be a huge aspect of defending the North. They seem like a natural fit for it.
For sure, it's a natural fit. On the space side of the business, the MDA Space side of the house, we recently announced in the fall a strategic agreement with the Department of National Defense and with the Telesat Corporation for us to be able to provide the satellite-based communications for the military into the future for Arctic communications in the North. That'll be a very, very large program. In this new 49 North activity, we'll be able to provide a range of different autonomous operations, sensor types, and communication activities for northern operations on the Navy, Army, and Air Force side of things.
And a big push with this defense spending is keeping Canadian companies, obviously yourself. Are you working with any other Canadian companies, or will you be trying to help develop other Canadian companies in this field?
I think it's really important for the Canadian companies to work together. We've just recently announced, announced on Monday by the Prime Minister, the defense industrial strategy for the country. I was certainly there at that announcement. It was a great announcement. We've been looking for this type of defense strategy in the country for decades now. In my 35 years of experience, this is a unique moment to be able to see everything come together to have a defense industrial strategy for Canada. And within that, there was the elements of build first in Canada, then partner internationally, and then buy when we have to. And on the build side, I think Canadian industry needs to work together to be able to make sure that we can collaborate and deliver the systems that the Canadian military needs. So we'll be looking as one of the larger defense prime contractors in Canada to be able to partner with other Canadian industry, to be able to build the Canadian military capacity, the systems that our military needs, to be able to perform and expand their role, in addition to partnering with international players to bring their capability into Canada and deliver it within Canada to create jobs and sovereignty within the Canadian environment.
Now, is the talent and the capabilities in Canada, do you feel?
I do. We've been very successful at hiring strong engineers over the last several years. In 2022, MDA Space hired over 700 people. In 2023, over 850. In 2024, over 900. So we've definitely demonstrated that we can attract engineering talent to our corporation and to the defense and space sectors. We will continue to do that. 49 North will be hiring as it goes through 2026 and starts to expand. And we will be teaming with Canadian and international partners to be able to create the industry consortiums necessary to deliver on Canada's expanded defense industrial spend.
All right, just one last question just on MDA Space. Latest on the EchoStar deal around that, there's a possible class action lawsuit. Can you talk to any of that?
Just that we'll be, defending ourselves well against that, defending against that event. Everything was done properly there, and we will aggressively be defending ourselves.
That was Mike Greenlee, CEO of MDA Space. Up next, Alamos Gold has reported their fourth quarter and year-end 2025 results. We'll break that down when we come back. Stay with us. Alamos Gold reported its fourth quarter results with record free cash flow, though production came in lower than expected after a challenging year at its Canadian operations. For more, we spoke with the company's CEO, John McCluskey.
20 years of production at Mulatos. We've produced close to 4 million ounces at that mine over that time. We've probably made in the order of $800 or $900 million in profit. That's been an exceptional operation for us. We had a great year on exploration. It's been the 7th consecutive year where we've expanded our reserves net of depletion. And we did particularly well at Island Gold, where we had a significant increase in reserves. So reserves were up over 16 million ounces across the company, and 8 million of those ounces are at our Island Gold complex. So that's been just a tremendous success for us. And despite the fact that we didn't produce quite as much as we had intended, we still hit record revenue, record free cash flow, record earnings, and that was, we still did quite well. We produced 545,000 ounces of gold at good costs, and that accounted for a very strong cash flow for the year.
And how is Mulatos looking? You said it's been great for 20 years. Where do you see it going over the next while?
Well, the big transition is coming up now. We've been investing quite heavily in development of a new deposit down there called PDA. It's higher grade underground, and what we've typically been mining is low grade open pit up till now. But we're looking at something like just over 1 million ounces in reserves at the PDA zone, and we're building a new mill, and we'll have that in production by 2027. That'll be the year we transition from open pit oxides to a high grade underground mining. So we're looking forward to that. We were one of the only companies in Mexico to get a permit of any consequence last year, and it was for the development of that mine. And it's going to mean that Mulatos will continue to produce well into the end of the 2030s, and I believe beyond.
Okay, and then the Island Gold District, there's an expansion. You call it transformational. What are the changes?
So we acquired Island Gold when it was a very small deposit, and back when it wasn't really very fashionable to do so, we were exploring very aggressively there, and we've taken reserves from under 1 million ounces to over 8 million ounces in that district, and that's net of close to 2 million ounces of depletion that we've mined in that district over time. So it's been just phenomenal growth. There's very little to compare with it. In fact, I was looking for an analogy for it, and the closest I could come to was the Golden Giant mine in Hemlo back, and was discovered in the 1980s and produced through the 1990s. And that's the only thing in Canada that shows anything close to what we're achieving here. It's very high grade. It's just under 11 grams. And we've really expanded the operation. We've been investing in a big project, putting in a shaft with the idea of going from ramp-driven mining to shaft-driven mining. It's a much lower cost, much more effective way to go. And we're going to be there by the end of this year. The shaft is almost at shaft bottom now. We'll have all the infrastructure completed by the year end. And that mine will transition towards the end of this year from a ramp operation to an underground operation. So that's going to drive the higher production and the lower cost.
And that's so reason for optimism for the Canadian operations and most of the challenges in behind you now?
Well, the challenges we face were really temporary. We were dealing with a very significant cold climate. We basically had one of the coldest winters in this region for something like 20 years. It's as long as anybody can remember. So we had lots of snowfall along with that cold weather, and it's the snowfall that's the biggest problem. It caused the road closures, and that really has an impact on the operation. It will be less of an impact going forward because ultimately we're going from running the primary mill at site, it's called the Magino Mill. We're running that off of compressed natural gas, and that means we're dependent on regular deliveries of that gas. We get 2 deliveries a week, and if it doesn't come in, we don't have any fuel. But going forward, we're hooking up to grid power. We've got a power line project that's underway, and that'll be completed towards the end of this year. Okay. And we'll no longer be reliant on those deliveries. So that's going to make a very significant impact on that operation, make us less vulnerable to weather conditions.
All right. And what's the latest on, you had to refile your financial statements in December?
That was actually a non-issue. It was actually our annual statement. And it was essentially a glitch in the software that was used by our auditors, and there was some miswording in their audit opinion. So we had to refile it with the correct wording. That's it. There was no change in our numbers or anything like that. It was our financials were as we originally filed them. We filed them literally 2 hours apart. So the numbers were all the same. It was just the wording in the audit opinion had to change.
Okay, I appreciate you clarifying that. You returned almost 81 million to shareholders in 2025, doubling 2024. What's 2026 looking like when it comes to dividends and buybacks?
Well, we just announced a pretty significant increase in our dividend, and that's not something a company would typically do when they're going through a period of fairly heavy capital expenditure, which we're going to be in for the next 3 years as we build out this Island Gold expansion project, plus our new Lynn Lake mine, which will start construction in the spring. So that's not typically a time you'd expect a company to be increasing the dividend, but we bumped it by 60%. So we're taking up from about 45 million a year to about 67 million a year. Okay. And I don't think that's going to be the last dividend increase you see from us.
That was John McCluskey, CEO of Alamos Gold. Well, Canadian gold producer Equinox Gold is surging today after beating estimates in the fourth quarter. It also declared its inaugural dividend. So for more on their future plans, we spoke to Darren Hall, CEO of Equinox Gold.
7 years to get us to the position to announce the inaugural dividend today. And it's off the basis of a significant deleveraging program over the last 6 months. Since the completion of the merger with Calibre in June, we've taken the company from approximately $1.4 billion US in net debt to ending January at less than $100 million. So, with positive gold price, with ramping up 2 Canadian assets, we see strong cash flow from operations, significantly deleveraged. So, I thought it was an opportune time to start with initial dividend. And, it's part of a longer term approach to returning capital to shareholders.
And at 0.015, is that where you'd like it to be? Would you like it to see more, or can you see it growing through the next little while?
No, I think it's a start up. It's a start of a journey to increase that return to capital to shareholders. I mean, we've got some fantastic organic growth in front of us, and given the buoyancy in metal price, the solid and reliable performance we see out of the operations, I think we can continue to fund the organic growth and look at increasing that return of capital to shareholders vis-a-vis both the dividend and we announced the application for an NCIB as well today. So.
And do you see that going forward? 5% of outstanding shares. Can you see that happening, or are you waiting for the right moment?
No, I think that we've applied with the full intent of being able to utilize that facility over the next 12 months. It's not a promotional gig. It's just, we'll see there's going to be opportunities where for whatever reason, we do see the opportunity to come in and buy shares in the market, particularly as we see ourselves undervalued with respect to a number of our peers. So, and when there's the days too, and we see a little bit of a slowing in the trade, we'll take the opportunity to pick that up.
And what would it take for that moment to happen to buy them back? You said a little bit of slowing in the trade, but what else would it take to convince you now's the time?
No, it's really it's a little liquidity position. We're in a good position from a liquidity profile. We're only early in. I mean, we've kind of made some pretty rapid changes here in the last 7 months, and we're putting in place these facilities, and we'll start to execute on this, over the next months.
Okay,
and now continue to ramp it up through the course of the year.
Sorry about that. And now you mentioned about organic growth. Where do you see that happening, and by how much?
Yeah, no, we have a kind of an almost an unrivaled organic growth pipeline, and particularly considering that these opportunities were identified a number of years ago when gold prices were much lower, but the company didn't have the capacity nor capability to be able to deliver those. Now, with the delivered balance sheet, with the organisation we have today and the buoyancy of metal price, it's setting up for a great 2027 and beyond. And specifically, we've got some organic growth in Canada with the expansion of the newly minted Valentine project to expand that capacity from its current 2.5 million tonne to 4.5 to 5, which we would intend to start that program this year. And then Castle Mountain in the United States, which is in the FAST-41 process. And, we've been insured by the US government. We'll have a record of decision here in late 2026, which will be our next phase of growth. And the sleeping giant in the background, which is Los Filos in Mexico, which we're encouraged by the recent discussions we're having with our stakeholders in Mexico, and some very positive change in sentiment there. So, no, we're in a very good position.
Any concerns in Mexico with what unfolded over the last little while with the kidnapping of those mine employees down there? Not with, of course, not with you.
A terrible situation, and my heart goes out to all of those impacted, the employees, friends, and family, the Vizsla team. I mean, a very tragic thing. In every environment that you operate in, there's idiosyncrasies and things you need to be aware of. Where we're operating, we have good relationships with all of our stakeholders. That doesn't mean it's not without risk, as is every environment. But no, we don't see anything in particular of concern in where we're operating. But you need to be aware, and you need to ensure that above all else, you're maintaining very positive relationships with the communities you operate in and the stakeholders in and around them. So, no, I'm comfortable with where we sit at Los Filos.
And with Brazil, I mean, it was sold. Is everything all cleaned up now? Is it all off the table?
Yes, it is. I mean, it's, the transaction closed on January 23rd, and we received $900 million, which immediately went into, a significant delivering activity in terms of repaying some fixed loans that we had, and also reducing our revolver, our overdraft, if you will, which was a significant contributor to our deleveraging. So, we're working through the transition out of the business with our partners at CMOC there as they pick up the operations and run forward. But it's the deal's closed, and we're moving on and focused on our Canadian assets, ramping up those, continuing our existing portfolio of assets in the Americas, and looking forward to these growth opportunities we see in the portfolio.
And that claim from the Bahia Group, what kind of an impact is that having?
No, there's a little noise in the background there with respect to, but we're very comfortable that we've transacted consistent with the laws and all of the environments our partners have as well. So we don't see a significant level of risk there, but there is a claim that we need to work through with a stakeholder to ensure that we do that respectfully and close out that chapter in. But the transaction is closed, cash is in the bank, it's been dispersed.
That was Darren Hall, CEO of Equinox Gold. Okay, before we wrap up here, we'll take one last look at where the day ended on Bay Street and Wall Street. TSX reaching another record high at 33,594 points to end the day. Not such good news for U.S. markets, though. S&P 500 and NASDAQ trading down to end the day. U.S.-Iran risks are spurring a rally in oil. Investors seem a little cautious on the U.S. side of things. And that's it for us today. Thanks for joining us on The Close.